The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Carolyn Roth, and these are your headlines. US markets prepare to return online after the Thanksgiving holiday, but an outage at exchange operator CME Group affects futures trading across equities, treasuries and commodities.
It's the final day of trade for what's been a volatile November, with significant moves across Europe's tech, healthcare and defense names, as investor fears of an AI bubble put the Nasdaq on course to break a 7-month winning streak. Russian President Vladimir Putin breaks his silence on Ukraine peace talks, saying the framework agreed by Washington and Kiev this week could form the basis of a future agreement. This as he prepares to welcome Hungary's leader later on today and U.S. envoy Steve Witkoff next week. Good morning, everyone. Happy Friday. Now, I do need to let you know, though, that U.S. futures this morning, they're not trading after the CME reported a cooling issue at its data centers. The company says it is working to resolve the issue and will advise clients of pre-open details as soon as they are available. Keep in mind, yesterday, U.S. markets were closed for the Thanksgiving holiday, but today we're seeing a holiday-shortened day of trading. But, of course, Karen, good morning to you. It is the final trading day of the month, and what a month it's been.
Indeed, and the situation you're just spelling out stateside may complicate the situation, but let's just recap. November has been an incredibly volatile month for equities, with fears over stretched AI valuations resurfacing several times, while investors were still digesting the latest earnings season on top of uncertainty over monetary policy. From a European perspective, here's what's happened over the month. The benchmark just managed to score some gains for the month, making November the 5th positive month in a row for the Stoxx 600. Healthcare was the stock's best sector performer in November, with huge swings upward for the likes of Roche and Bayer after both firms posted strong trial data. Roche is up by nearly a fifth for the month after a trial showed one of its oral drugs is effective in cutting the risk of breast cancer recurrence. While Bayer posted its best day since 2009 on the back of an anticoagulant drug study. Meanwhile, French firm Abivax has continued its monster swing upward, now up more than 1,500% for the year, as investors continue to flock to the stock amid promising data around its ulcerative colitis drug. Meanwhile, tech names have taken a beating this month. ASML down more than 15% on the month, as the US AI sell-off spread across Europe. Don't forget, stateside, it was a mixed trading month, and just this week, very strong gains in a lot of those tech stocks. Defense names also seen with losses, with Henshot down by nearly a quarter for the month after JP Morgan cut the stock to neutral on delayed growth guidance at its capital markets day. I'll just plug into that has been a little bit uncertain and choppy around the direction for defense stocks, thanks to some progress potentially around the war in Ukraine. A quick look at what European futures are doing this morning as we gear up for the start of the trading session. More positive, and we've seen that in the last couple of sessions, that the markets have been looking to try and ink out fresh territory to the upside. Our next guest says that AI will remain a structural growth theme in 2026, but warns that overinvestment and electricity shortages could dampen expectations. Christian Nolting joins us, the CIO at Deutsche Bank. Christian, thank you so much for joining us today. I'm interested to hear your thoughts, given there's been so much talk about bubble-like territory in parts of the AI trade versus others that still think we're early days in this massive build-out. How are you thinking about the AI story?
Yeah, I think I agree. It's a massive build-up, but maybe we should not always look at the chip side. Maybe you should look at the whole value chain. So there's also data center, there's cooling. See the issue this morning, of course, which tells a story, I think. So we need to look a little bit down the value chain as well. But it's a structural change, and we don't think it's a bubble. We still think it's rather a boom.
Fascinating that you also just put into the conversation point the CME story and that the issues they've had with cooling, because I was looking at that too, whether there's a disruption today on the trading session, whether we are talking about this story in a one-off or whether it is also some sort of signaling for what could go wrong in cooling centres more broadly with the huge reliance that's going to take place on data centres in future. As you talk about the build-out, what do you think is priced in already around utilities and powering some of these enormous data centres versus what is still to come?
Yeah, we did analyze this a little bit because there's a massive build-up indeed. Just to give you the numbers, if you look at the amount of money which is spent out of the earnings of the S&P 500, it's roughly 35% in that direction. That's certainly a lot. We still think, and that's, I think, important to understand, that's necessary because we think there's a lot of demand for data. If it would go much higher, I would say that's probably a bit too much. And sometimes you see that overshooting in investments. And that's something the market, of course, looks very closely at. And I think this will follow through also for 2026. So it could be a more volatile year on this AI trends, but I think it's structural. And we probably need to deal with that. And if there are setbacks, we still think it's a buying opportunity.
Christian, this is Carolyn joining in. Let me ask you more broadly, though, because the rally that we've seen unfold over the course of this year has been called the everything rally by many in the market. We've seen Bitcoin, gold, equities, even bonds performing very well. Are investors starting to become a lot more discerning, even though you say the AI rally or the AI build out is set to continue?
Yeah, I would say let's not only look at this year. If you look since 2023, I think the S&P is up more than 80%. I think it's only worth to have a look and say, can that continue like this? I would say it's only fair to say if we don't see the same gains as in 2025 and 26, but I would still say it's a positive year because we do have a lot of spending. We just talked about this. We do have a lot of fiscal policy coming up again in 2026. And we have a lot of central banks to cut, which normally is a positive environment for markets.
What does all of that mean for the dollar, though? We talked about the AI dominance coming from the U.S., all that investment flowing to the United States, and that would, I assume, support growth, but also the dollar. And then, of course, we've got the Fed, and it will be heavily impacted by politics going into 2026. Does that mean that the dollar's kind of torn between the bulls and the bears? How do you see it?
Yeah, actually, that's the way we see it, to be very honest. So looking back at 2025, we have seen a weakening dollar first and then a strengthening dollar because there is a lot of productivity gains in the US. There's a lot of money which is invested in the US. That won't change. On the other hand, yes, there are some cuts from the Fed to be expected. We think it's 3 for the next 12 months, by the way. And so it's a bit torn, and that's why our dollar forecast is rather sideways but volatile.
Christian, how do you feel about fixed income, the steepening trade? That's been the way to go this year. The yield is still pretty attractive when it comes to sovereigns, but a lot of investors have told us on the show to look at corporate credit, even though spreads have been historically tight. What's the best way to play the fixed income market from here on out?
Yes, I think if you think of a multi-asset portfolio, I would also go for investment grade plus equities instead of putting everything in high yield because there as well spreads are very tight. Nevertheless, it's really tough for us, and that's good news, I think, to see a recession coming up, which would massively widen spreads from my point of view. So we don't expect this with all the fiscal policy, with central banks rather cutting rates. So that's good news. But I would still see, if you look at real rates, they are positive, and that's good news. From that perspective, you can clip some coupons. There's probably not so much on the price you can gain, but I think it makes a lot of sense. It's probably not a bad year for fixed income. It's not a stellar year, but I think there is some performance to be made, absolutely.
Christian, I was just looking at your chart on Europe and how yields are performing here, and you point out there's been a European renaissance, sentiment has fully recovered, but crucially you point out that the new macro regime has not yet been priced in. That is fascinating. If you look at the stock market too, in recent months, there's been a lack of enthusiasm for European stocks again back into the second half of this year. Do you think any of this changes into 2026?
Yeah, here, if I may, I can look at the 2025. Look at the first quarter where Europe was really outperforming because there was the fiscal policy coming up, and especially from Germany as the largest economy. And there has been some, I would say, disappointment that not so much is implemented. It took some time here in Germany to put the government together, to come up with a new budget. This is in place now, but I think it will take into 2026 before we see growth rates. I think the market wants to see really some change. There's some doubt, but if you look at our growth forecast, for example, for Germany, is 1.3 to 1.5% for 2026. I think if the market sees these results, there's probably some optimism coming back. And I would say that's good news. But I agree, we really need to see that happening first.
Talking to a fund manager who was saying to me, look, it feels as though the market has forgotten about that big German fiscal stimulus that is coming next year. As you look at the broader sentiment gauge for holding global equities, do you think Europe is still part of that diversification trade, or has that really just started to also retreat from the highs that we saw earlier this year?
Yeah, I think, as I said, in the first quarter, it was. Is it a massive diversification trade at this point in time? I doubt, to be very honest, if you look at the performance difference. This month was a bit better for Europe, as you said at the beginning. I would say the market eventually will look at growth rates. As I said, yes, fiscal policy will bring up growth in 2026. But there's more productivity gains from the US than from Europe. So I would say there's still some slight outperformance in the US if you compare this to Europe. But we would still say it's both positive performance. But it's not that I see a massive outperformance now in Europe. The good news would come, I think, if the growth is really seen in numbers, which we would expect in the first quarter next year.
That really does contextualize it, Christian. Thank you very much for that. Let me ask you about the hyperscalers a bit more, because you have another chart that is fascinating, which points out about the amount of hyperscalers in the United States and China. And there's a huge dominant picture there versus what we've got elsewhere. Germany, Singapore, not as far behind as the rest, but it starts to peter off as you go through various different countries from there. Is that an opportunity that means more dollars coming back into the likes of Nvidia and maybe even Alphabet, Google this week? Or is there going to be a dispersion? Do you see countries playing in this build out of AI data centers like in France, where Mistral AI is part of that story? I mean, how do we think about who benefits from other countries having to bulk up and hyperscaling?
Yeah, you could say maybe the US is the first to have been profiting from this. And I think it moves also to other areas. But let's not forget the massive build out is certainly coming in the US. And I think that won't change. Other countries really need to really closely follow up. But I think, as I said, right, there's a massive amount of investments, especially in the US. I think if we see other countries to follow through, the market will certainly watch this, and investments are needed. We see this in the US, and that's an opportunity as well. It's also an opportunity, by the way, on electricity, which is needed there. So, as I said, the value chain is very important for 2026 if you look into this. So this is something really to be closely watched.
One of the riskiest parts of investing is becoming too concentrated, and arguably this has happened to a lot of investors, and they've done pretty well with that concentration when it comes to tech stocks so far this year. Christian, what about the small and medium caps, though? We've long thought that they would benefit from the rate cuts, but it hasn't been as convincing as many people would have expected. Is 2026 going to be the year of medium, small caps?
Yeah, I think medium small caps, you would look at if the economy is doing better, they would do better. So if you look, for example, at the US economy, a lot indeed is driven by this AI trade. The other areas of the industry are not always doing so well. Same in Europe. Once we have seen the discussion, again, let me quote this, sorry to do this again, on fiscal policy, then you see MDAX, for example, in Germany performing very well. Once this is in question, then there's underperformance. Again, I would say if the economy is coming back, we have a soft patch in the US. We think it's coming back in Europe as well in the first quarter. I think there is some outperformance in the smaller mid-cap stocks certainly possible. What's also important for me to stress, if you look at 2026, yes, this market breadth has not been very, let's say, large. So it was really focused on a single equities trade. I think that would be the wrong setup for 2026. I would expect momentum trade to shift to other areas as well. And this month, as you said, it's over now, has been a good example for this because other areas has also started to perform. And I think that's very important. So diversification, not to look too much into tech and AI only, which is a driver, but really we need to diversify the portfolio, which is, I think, very, very important for 26.
Diversification, but also hedging, I assume, Christian, is going to be absolutely key. What about gold here? Because, again, the rally that we've seen so far in gold this year has been somewhat puzzling. We don't really know where it's coming from. Is it, just down to the big central banks buying? Is it actually a hedge? Is it inflation concerns? Is it simply too much liquidity in the market? And I don't know how you feel about the key factor that's been driving the price of bullion and whether that's set to continue.
I think it will continue. So to give you a number, our forecast is 4,500 for gold, so more upside from here towards the end of the year. So not the same performance as this year, but still up. I think there's two drivers from my point of view. First of all, you have demand from the central banks. This will continue, but also from retail investors. But there's also all this discussion about diversification of the currency, and gold then is seen as a currency. And we should not forget, with all that fiscal spending, we have really governments to, of course, put more money on the table. And people say, is this sustainable for a very long time? It is probably, but it could also run into a crisis at one point in time. And I think that's why this diversification is there, to also look at gold. It's not so much hedging only, I would say. It's really demand and diversification on the currency side, and also from the massive fiscal spending we are seeing.
Speaking of going for gold, Christian, the Indian stock market, we've seen record after record, that market very much stretched to the upside. Chinese stocks had been going in that direction, but coming off the highs just in recent weeks. What do you make of the shift that we're seeing here in this big emerging market trade?
There is a big emerging market trade for sure. We are still positive. China, India, we always say, and that's not new, the Indian market is a bit more expensive, but you see growth there. You probably see higher growth in India than in China. We think China is cooling off a bit, still above 4% growth, which is massive. Let's not forget this if you compare this to the US, to Europe. But nevertheless, also here in Asia, I think diversification is very important. But if you think through all of this, Asia could be a winner of all this situation we see, or say parts of the global south. And that's why you also see money flowing substantially into Asia. And I would say that's continuing also for next year. I wouldn't be surprised if we see at least the same or not even better performance there than in Europe and the US.
It does jump out to me, Christian, that the Chinese have been playing hardball with the Americans on trade versus others that have simply caved to the demands. Do you think that has been holding the Chinese market back because of the trade situation and lack of a deal?
No, I would say there's some peace at this point in time, right? So once you have the hyperscalers in the US, you also have the rare earth discussion in China. So it's a bit balanced, which I think is not bad from my point of view. So there can also be bouts of volatility coming from that trade, let's call it discussions. But I think both poles need to, or know that they need to somehow work together. I think that's positive news. But if there's negative news, that's also, of course, always weighing on the markets. But I would say on both sides, not only on the Chinese or not only on the US market. So that needs to work together, and it's a precondition for a good performance in 2026, not only for the US, but also for China. Then for China, of course, you always have this issue on real estate. Recent days, we had some news again about this. I think this won't go away. This is holding back the market a little bit. But if you look outside of this sector, I think there are some very positive developments as well. So China has done a lot also on the technology space, and I think that also belongs to the portfolio.
Christian, thank you so much for this wide-ranging interview. Really appreciate your views this morning. Christian Nolting, the CIO of Deutsche Bank. And still coming up on the show, we'll bring you all the latest developments surrounding Ukraine as the U.S. continues to pursue a potential peace deal. Plus, Germany's Bundestag looks set to approve an over 500 billion euro spending plan and unprecedented borrowing levels. And of course, we'll discuss all the fallout from the UK budget with former Business Secretary Vince Cable. That conversation is coming up at 9:30 London time. We'll be back in 2.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Russian President Vladimir Putin has said that the US-Ukraine draft peace proposal could form the framework for a future peace deal, but that if talks fail, Russia would continue to fight. This comes after a leaked 28-point US peace plan arose last week, causing concern amongst Ukrainian and European officials who felt it bowed to Moscow's key demands on NATO. We've spoken to a number of Ukrainian MPs and business leaders this week about their expectations for the peace agreement.
One of the reasons is the will of some of the political leadership in the United States to force us to sign something before Thanksgiving Day, which would be a victory that Mr. Trump could present to his audience, but this is not what is going to happen.
You cannot hope that overnight they will start acting according to international agreements and obey to the international laws. We should be taking into account that it's not that Russia wants peace. They can be only pressured to peace with the threat that they will restart the war at any single moment. And this is why we cannot give up neither our territories nor any tactical positions that will allow us to better defend Ukraine.
Do we have any choice to stop fighting? Of course not. It becomes more and more difficult for us, especially talking about energy system, to maintain it in the condition that people have lights and heat. That's, as I said, one of the most difficult winter coming, but we're ready to do everything possible to go through this winter and not allow Putin to switch off Ukraine.
Meanwhile, Ukrainian officials say anti-corruption authorities have conducted searches at the office of President Zelensky's chief of staff days after a scandal involving the country's nuclear energy body, and key figures at the heart of government rocked the country, with government employees allegedly securing kickbacks north of $75 million. Meantime, Hungarian Prime Minister Viktor Orban will meet with Russia's President Putin in Moscow today to discuss oil and gas supplies to Hungary and peace efforts in Ukraine. The meeting comes as Hungary considers a move to take ownership of a Russian-owned refinery in Serbia, effectively shut down by U.S. sanctions. Belgium's prime minister has reportedly stepped up his criticism of an EU plan to use frozen Russian assets to finance a loan to Ukraine. Politico and the Financial Times say Bart de Wever sent a letter to the European Commission saying that using the funds could prevent a peace deal between Ukraine and Russia, and demanding binding commitments from EU countries to cover the 185 billion euros held at the Euroclear Bank in the event Russia reclaims the assets. This is a fast-moving story. Sylvia joins us in the studio. Sylvia, what's your sense of how divisive this issue is going to get?
Well, there's a huge question mark at this stage about whether the EU will manage to get a deal before the end of the year on how to use the so-called frozen Russian assets that are currently held on the European continent in order to support Ukraine from a financial point of view. So what we have at this stage is indeed reports suggesting that Belgium has in effect escalated its criticism, and it's worth keeping in mind that Belgium is the country that has the majority of these frozen Russian assets, hence why it plays such an important role in these conversations. And indeed, we have reached out to the European Commission, we have reached out to the Belgian government for comment. We're still waiting for a reaction from both institutions, but it just highlights that the conversations are getting more and more difficult. The argument that we're getting at this stage from the Belgian government is that if we see an agreement on these funds that is conducted in a very rapid way, that could put at risk the ongoing conversations around how to draft a peace agreement for Ukraine. And so the reported solution that Belgium is putting forward is actually using untapped borrowing powers that the EU has in order to support Ukraine in the new year. But we're talking about roughly 45 billion euros here. That is a lot less from the 140 billion euros that the European Commission is keen to put forward in a format of reparation loans for Ukraine. We have heard as well from the European Commission this week, the President Ursula von der Leyen suggested that they are on track to put forward a proposal on this topic very soon. So let's see when that proposal will be put forward. But the reality is that you have ongoing criticism here from Belgium, and you need them on your side if you're going to go ahead with this plan.
The Europeans have been doing a ton of work, clearly, around these frozen assets. But if I can circle back to the main point as to whether Russia even wants to see a peace agreement at this stage, just reading between the language, Putin was talking about the discussion so far, not about a draft agreement, but a set of issues that they're still dealing with. Number one, he wants the Ukrainians to pull back in the fighting, to lay down weapons and pull back first up. I mean, in any tactical fight, that is very unusual for a demand like that to happen. The other point, he's calling the Ukrainian leadership illegitimate, so impossible to sign a deal with Kyiv. I mean, how do we think about this whole process that, we need to see the government fall and fresh elections to be held even before there is going to be any signing of an agreement?
The Europeans have been very clear that all of these demands are only coming from the Russian side, and they are not supportive of this whatsoever. In fact, Kaja Kallas, the top diplomat, made the comment that if the proposal remains with these points, it will be very difficult to see a peace deal taking shape. I'll just highlight one comment from the Russian president, who actually said that using the Russian frozen funds would be considered theft, and that they are preparing here for retaliation measures against the EU if they go ahead with that. So that is also not helping the conversations here on how to support Ukraine in the meantime.
Well, I see a series of hurdles stacked up on the track ahead for Europe and the US to confront. Sylvia, thank you very much.